how do you predict, right? How do you predict gaps? Technically, there are no way to predict the gap. You cannot predict. Why? Because there is a good 16-17 hour of gap, right, between the time the market closes, and anything can happen. But yeah, definitely there are some indicators that you should look at. But usual understanding is you should not be trading just based on your gut feeling, or you should not try to predict, right? Always have some hedging position and all that. We'll talk about a little bit of risk management as well, as to what are the things that you should be doing when you buy calls towards the call side or a put side, whatever. We'll be talking about that. And then when you are trapped, right, as to if you are trapped, then how do you come out of it is something very, very important. We'll be talking about that as well in this session. Now, there are no way to predict, but still there are some indicators that will surely help, right? So one is the FII DI data. Daily evening, exchange provides you all the information as to, what was the overall buying and selling data that comes in. After 6 o'clock, you will have that data available at multiple different websites. Even Liquid has it. You can go there, figure it out. So that is one thing that basically talks about what are the bigger player sentiment towards this. Put call ratio is somewhat related to that only, so we will be talking about that a little bit. Next one is VIX, the India VIX, that is the volatility indicator, right? It's very, very important to know as to how the VIX moved today, right, during the day, and then it will set the course for the next day, what is going to happen. We will be taking today's chart into example, and then we will see that how we can think about the prediction that what is going to happen tomorrow, right? US 30 is one another indicator. So basically, these are the future contract that keep trading during the Indian daytime as well. That is also a good indicator. So those are like US 30. That index is US 30. You can go and then you can keep seeing as to how the future move. Usually, when the market opens, they kind of replicate this as well. So even before the market closes, it actually gives you a good sentiment towards it. All right. So next one is how do you do the risk management? Very important, guys. This is the last slide. After that, we'll jump right into the technical chart and see how do you trade that, right? So bear with me. There are a mixed audience wherein some of you are already pro in it, some of you are not. So the idea is to talk about everybody. I'll not take more than 2-3 minutes into this slide. So whenever there are event, let's not be a little bit more adventurous towards it. The idea is do not trade whenever the event will pan out and we see that which direction market is going. There is always a time. So there is not even a single day wherein you do not get opportunity on either side, right? It is just that you need to understand when do you catch it. But there is no heroism in trying to figure out that, hey, tomorrow there will be a gap down, so that's why let me buy a put, right? Most of the trader usually lose money, right? So there are a lot of statistics around that 95 to 99% of the intraday trader or the short-term trader actually lose money, and this is the reason, because instead of thinking about and then going with the flow of the market, we try to predict market. Never try to predict the market in a shorter term time frame. It's not gonna work, right? So there are a lot of intelligence already built around, a lot of algo. People are already there in the system. It's very, very difficult. Why getting into that wherein you can get into trouble? Next, hedging your position is very important. As an option buyer, that's the problem, because you always have a little bit lesser capital, right, wherein you play with. And if you try to hedge your position, then either you buy a put and then a corresponding call, and when the market actually gives you a little bit of consolidation, you kind of lose the premium in both sides, right? So hedging a position as an option buyer is very, very difficult. But the idea is do not overexpose yourself. So by this point, what I mean is do not overexpose yourself that I will think about, hey, tomorrow there will be a gap up because last moment Nifty did a rally today, so tomorrow there can be a gap up, and it did sustain 17,850 critical level, right? Like I'm just talking about today, 17,850 ka jo critical level tha, actually it was well respected, right? We did a good rally at the end, but that doesn't mean that I'll go and then buy 50 lots of Nifty and think that tomorrow something will happen. What will happen if all those sentiment, whatever we gained in last 1 hour or so, will vanish in next 5 hours or so when US market will open, right? Or some other new thing will happen. You will kind of lose your capital. Do not do that. Monthly contract is something that are little bit more stable as a weekly contract. Never ever buy a naked call is something that is a mantra, right? Or If not, right, then definitely do not overexpose. One position, maybe one lot or something is fine, depending upon what is your over capital or so. If you are very very confident and it is mandatory for you that every day I will minimum take one one put or call home, if you want to do that, that is something not advisable technically, right? And most important is, anything can happen tomorrow morning when you come down, right? Is core about how the option buyer would react to it, right? So when you so there are 8 scenarios that can happen. Let's talk about those scenarios. You bought a call and then there was a gap up, right? And after the market opened, right, the market is actually going up. So that is the first scenario that can happen. The another scenario that can happen when you actually bought a call is there was a gap down. Now within gap down also there are 2 scenarios that can happen. Is after gap down there is a sign of recovery, and the another scenario can be after gap down the market is actually tanking even more. What should you do? So there are 4 scenarios that can happen when you take a call. 2 part of the gap up, 2 part of the gap down, and same thing towards the put side, right? You took a put, you bought a put, and then you took it home. Next day there was a gap up. Now you are kind of thinking as to what should I do now, right? I have already lost 100 points. What should be my strategy, right? So then again you should also look at what is the market movement towards the next day, and how do you track it? You track it 15 minute, 5 minute, 3 minute, 1 minute, 15 second, 1 hour. What is that you should do, right? So we'll be talking about that.